Hey everyone, Richard Norris here, and in today's video I want to talk to you about how to set up your property portfolio so that it's tax efficient. But before we get into the granular details of how to do that, for those of you who don't know me and for those of you who are not familiar with who I am, everything that I share on my YouTube channel is coming from a place of personal experience. I'm just sharing things that I've done, things that have worked for me, and also things that we're doing with our clients and things that have worked for them too. So here's a disclaimer before we go into telling you about how to set up your property portfolio so that it's tax efficient. I'm not a property tax specialist or an accountant. I definitely know about property taxes and a little bit about property accountancy and how all of that works and stuff, but I'm not a qualified tax specialist or an accountant. But I do have a team of qualified people, and within our program Property Investors Accelerator, we have a number of subcontracts and affiliate agreements in place with tax specialists and qualified accountants as well. So what I'm sharing with you in this video today is basically information that I've learned from doing with these people, and you shouldn't take any of the information that I share with you today as personal information towards your own tax assessments. You definitely need to have your own property tax specialist and a property accountant to help you implement what I'm talking about in today's video. So with that out of the way, let's jump in. So mainly, a number of people, when they start a property business, are typically advised to set up a limited company structure, and the majority of buy-to-let mortgages are done in limited companies. And typically, there are about 85% of buy-to-let mortgages that go through the market today are done in a limited company structure. And the main reason for that is because of the Section 24 tax changes that came into full effect in 2020, meant that you couldn't offset any of your finance costs against rental income, and this was a big problem for higher rate taxpayers. And so most people are now advised to set up their property portfolio in a limited company structure. But the biggest mistake that people make, from my experience of doing this and working with a number of clients, is that when they set up a limited company, they ask their accountant to set one up for them. And if they do this, the accountant usually sets them up with one ordinary share for the business, or they give them 100 ordinary A shares. And this isn't the most tax efficient way to grow a business on somebody's personal individual assessment. And what I mean by that is well, the problem here is accountants aren't property investors, and they typically look at what have happened in the past, and so they don't look at the future and have forward thinking. And it's not their job to do these things as well, to be fair to them. Accountants are just there to really advise on what are your rental profits, what profits do you have to pay for the year, what sort of costs and expenditure did you have, and to do your bookkeeping each month. You really need a property tax specialist to set up your property limited company in the most tax efficient way if you want to be prudent about this. Now, the other thing that we see a lot is that people go online and just set one up themselves. And again, it's not the most tax efficient to do. It doesn't provide them with any income tax efficiency, and it also doesn't protect them from inheritance tax. And that's really important if you're a person who has a family, or even if you don't have your own children or stuff like that, in the future you might. And if you're thinking about intergenerational wealth. Now, the structure of the business is fundamentally fragile if you don't set the company up in the right way. And we see this a lot. And the analogy I use is when you're going to start to build your dream home, for instance, you wouldn't build your dream home on foundations that basically have subsidence. And although it sounds relatively straightforward, in practice, people just don't do this. And so they set up their property companies without tax expert advice, and they end up using an accountant, or they set it up themselves, and the structure of the business is fundamentally fragile. So when we try and scale that, it just breaks, and basically they're just putting all of their hard-earned money into a bucket with a hole in the bottom. So what we really recommend is when you're getting or starting a property portfolio, and you want to think about setting up the company in the most tax efficient way, we typically recommend that if inheritance tax is important to you and you're somebody who has a family, maybe you have children and maybe your kids go to private school or maybe they just go to state school, but at some point in their life the children are going to go through some sort of education, then we'd recommend that you set up a family investment company, which is also otherwise known as a smart company via other tax specialists in the market that you may be aware of. Now, the reason why I talk about like kids' education fees and things like that is you're going to see in a minute when I take you through a client case study the importance of setting up a family investment company and the benefit that that can bring if you are somebody who is a parent and has children and your kids are going to go to university or you're paying school fees for them. So basically, what is a family investment company? Well, a family investment company basically has alphabet shares, and it's basically the most optimal share structure. And we're going to go through that. We basically cover things like freezer shares, growth shares, and a discretionary trust. And by having an alphabet share structure, which I'm going to show you in a second, you can start to use other people's marginal rate of tax, which is really beneficial when you're a higher rate taxpayer for income tax purposes. And secondly, the other thing is like freezer shares. Well, when you transfer shares to people in your bloodline, so maybe your children in the future, at the moment that you do the transfer is crystallized, and therefore that you basically end up paying capital gains tax. So by having a family investment company in place, you can mitigate any capital gains tax on the transfer of your shares. And I'm going to go into in more detail in a second all about growth shares and all about why we set up a discretionary trust and the importance of having these things over a normal limited company. Now, just to reiterate here, I think I touched upon this a second ago, but just to reiterate, who needs a family investment company? Well, a family investment company is really for anyone who is a property investor and is worried about inheritance tax. And, you know, typically people who are high rate taxpayers and have long-term thinking in mind, like they're going to breach the inheritance tax allowance at some point in the lifetime of growing their portfolio. And at that point, when you transfer any assets that you own to your children or your grandchildren or any family or heirs that you want to leave your properties to, you're going to end up with the people that basically take the properties off of you. They're going to end up with a 40% inheritance tax bill. Now, a family investment company is great at protecting that. It means that you typically don't pay any inheritance tax at all when you set up a property family investment company. Whereas if you set up a normal limited company, you do have all of the value of your estate building in your own name, and therefore inheritance tax is due upon death. Now, if you are somebody who has children or has grandchildren or is thinking about grandchildren in the future and somebody's worried about inheritance tax or wants to plan for income tax efficiency, then a family investment company is typically best for you, for your type of persona and your type of situation. Now, what I'm also going to explain in this video is all about the benefits of a family investment company. I'm going to go through the considerations and drawbacks of a family investment company, and then I'm going to show you what's working for our clients and a client case study that we recently did where we implemented a family investment company for them, the reasons for doing so, and legitimately the amount of costs that they saved by implementing the tax, which when you see this in a second, like it's just crazy the amount of tax that they save with one of these. So you really want to hang around and pay attention to this next part here. So let me go into a client case study that talks around family investment companies and what they are. So what is a family investment company structure and what does it look like, and what does a typical family investment company share structure consist of? Now, again, like I say, the information that I'm sharing with you here is information that's been taken and extracted from our tax specialist that we use. And we use a company called Property 118, who you may be familiar with. And I'm sharing in this client case study the situation that we basically helped our client with and used the services of Property 118 to do that, which is something that we regularly do with a lot of our clients. So for the purposes of explaining a family investment company, what it is and how it can help you, I've just used a typical example of a family, and I've used a typical example of husband and wife being James and Sarah in this situation. And James and Sarah have 2 children, and they are also thinking about grandchildren in the future. But for the purpose of this situation, the example, so to bring clarity to it and to bring it to real life, James and Sarah potentially mid-30s, early 40s, and have a couple of kids. And in this scenario, the kids are going to private school, and I'm going to explain how this is beneficial in that situation. But notwithstanding the fact that if your children don't go to private school, this is still relevant to you if you have a family, and the benefits are still considerable, and there are considerable savings to be made. So with that said, and without further ado, let's go into this. So James, Sarah, we basically give them freezer shares. So when we set up the company, we give them freezer shares. And you can see here that the number of shares that are allocated in a family investment company, typically when we set them up from scratch, is around 10,000 shares. And each of those shares are valued at a penny. Now, you can see that James and Sarah are given the majority of the shares in this situation. And we've given James 4,930 shares, and we've given Sarah 4,920 shares. So they basically own 95% of the company. And all of the shares are valued at a penny, which means their total share value is £49.30, and in Sarah's case, £49.20. And in the case of the children and the future grandchildren that may or may not be born yet, for the purposes of this conversation, and even their parents and in-laws, basically, their share value is only 10 pence. They're only given 10 shares at a penny. So why do we set up the company in this way? Well, notoriously, when you set up a company, you have something called voting rights, dividend rights, and capital growth rights. Now, in a normal company, without a smart company structure in place, such as this, you would basically have ordinary shares, and all of the shares might be split between you and your wife, or husband and wife. And you would be given voting rights, dividend rights, and capital growth rights. Again, the biggest problem with this is that you both have all of the control. You can take dividends, but the biggest problem is that the capital growth sits inside your estate, and then therefore any growth within the company that accrues within the company is taxable at 40%. So what we do is we basically freeze the shares on the day of incorporation. And the main reason that we freeze the shares on the day of incorporation over a normal company is that if we don't freeze the shares, when we transfer these shares maybe to our son or our daughter or our children in the future, when we transfer those shares upon death or later on in our life, those shares get crystallized at the transfer, and they get crystallized at the value of the transfer at that point, and we end up paying capital gains tax to transfer the shares to our children. So what we typically do is we freeze the shares, so that as we grow the company, the shares are only ever valued at £49, and in this scenario down here at 10 pence. This basically means that when you transfer these shares to any of your children, that you're not going to be paying any capital gains tax, so it mitigates that problem. Now, the next thing that we do is that we basically start to give you voting rights, dividend rights, but we don't give you any capital rights. So voting rights are who has control over the company, and we only give them to the owners of the company, which in this case is James and Sarah. And we don't give any voting rights to any of their children or any of their future grandchildren or any of their parents or basically in-laws. And the reason for that is that we want to own control of the company. We want to be in full control so that we can make all of the decisions, and any of these shareholders that we put in place purely for tax purposes cannot make any decisions over what we do in the company, and they don't have any control. So that's the reason that we do that. Then what we do is we give all of the shareholders dividends. Now, the reason that we give dividends is so that these can be extracted at people's marginal rates of tax. So when everyone's born, they're basically given a £12,500 tax allowance. And then basically you pay dividends on top at 7.5%. So 12,500 is tax free, and then anything above £12,500 that you take as a dividend is taxable at just 7.5% up to £50,000, and then it's taxable at 38.5% above 50,000. So the reason that we basically give everyone dividends rights is so that we can start to use their marginal rate tax band and their lower rate tax bracket. So for the purpose of this situation here in this example, let's imagine that these two children are, maybe 10 and 14. Both of the children are therefore given dividend rights. And down here, James and Sarah are planning for future grandchildren, and they've got their in-laws on the company as well. Now, the reason that we plan for future grandchildren is that it doesn't matter if they are born or not born in a fictitious situation. It's purely for the purposes of tax planning. So even if we plan that we're going to have 10 grandchildren and we only end up with 6, it does not matter. There's no implications of adding future grandchildren. It's just set up for tax purposes. Now, what we typically do is we don't give any voting rights and we just give the dividend rights. So on the dividends, when we extract the dividends, we can extract these at 7.5% up to 50,000 and 38.5% above that. Now, let's say, for example, in this situation that James is a high rate taxpayer and Sarah is a marginal rate taxpayer, and obviously the children are marginal rate taxpayers because they don't have jobs at this point. And then we have mother-in-law and father-in-law, and all of those are just taking their standard pension contributions, and therefore they're marginal rate taxpayers as well. So we can basically start to allocate profits from the property company, and we can start to allocate those profits in form of dividend to any of our shareholders. Now, the important thing to note is that if your children are below 16, typically 18, then we can't declare them a dividend, because if we do declare them a dividend, and they're under the age of 16 or 18, we basically get taxed on our own rate of tax. So if we're a 40% taxpayer and we made £1 million of profit and we allocated £100,000 to the freezer share class C, which is the son of James and Sarah, who's 14 years old, then we'd be taxed at 40% we'd be taxed at 38.5%, the higher dividend tax bracket, because we cannot declare a dividend to our children because it falls within inside settlement legislation. However, the moment that the children are above 18 or 16, and they basically can do activities within the business, we can start to pay them a dividend and we can start to use their marginal rate tax bracket, and it doesn't get taxed on our rate at that point. This is really useful for when your children go to university. We can basically pay the university fees to our children, utilizing their £12,500 tax-free allowance and their dividend allowance, of which £2,000 is tax-free on the dividend. So you can have £14,500 for each individual out of the company profits tax-free. And then you pay just 7.5% above that. So effectively, when we pay our kids' university fees through the profits of the property company, this becomes extremely tax efficient. Now, if we have a scenario where potentially you're watching this video and you have children that go to private school fees, most people do that inefficiently in a normal limited company. And most people from experience of doing this pay their children's private school fees out of their 40% taxed income. They're usually high rate taxpayers, they have good jobs, or they're running a business, and they're paying high rate tax on the dividend, or they're paying high rate tax at 40% if they're employed. And this is very inefficient, because what you can do in the property business when you set this up in the right way with the family investment company structure is you can structure the company in a way where you can basically pay the children's school fees using your in-laws marginal rate tax brand. So what do I mean by that? So in this scenario, we have James and Sarah. We have two children, and both of the children go to private school. And we have effectively the children's grandparents, which are the parents of James or the parents of Sarah. And what we can do in this scenario is we can basically start allocating a dividend and using the marginal rate tax band of your parents, or in this situation, James and Sarah's in-laws as well. So we can start to extract dividends at the lower rate of just 7.5% to the in-laws, and then the in-laws can basically pay the kids' private school fees. So that's a way that we can extract money out of the company to pay for the children's private school fees in a much more tax efficient way than you may be doing right now if you're a higher rate taxpayer. Now, with that being said, even if your kids don't go to private school, this is brilliant for income tax planning, but it's also brilliant for inheritance tax planning as well. So it's not only for people whose kids go to private school fees, but a major benefit of having a family investment company and setting it up in this way is that you can pay the kids' private school fees out of the company using marginal rate tax band. Now, the other thing that we do is we basically don't attribute any capital growth. Any capital growth within the business is not allocated to the parents, so to James and Sarah, who are the owners of the business, and they're not also allocated to any of the bloodline as well. So any of James and Sarah's children, grandchildren, or in-laws, they don't have capital rights either, and they're pushed into a discretionary trust. And the reason that we do this, the reason that we push them into a discretionary trust and we give them growth shares, is that when we grow a property business, so let's say that James and Sarah had £1 million to start the business, and they brought, say, I don't know, 3, 4, even £5 million worth of property with the £1 million. In that scenario, as the properties grow in value, and let's say that James and Sarah have utilised their nil rate inheritance tax band of £325,000 per person, so £650,000 as a married couple. Let's say that they've utilised the nil rate tax band and their estate is above £650,000. Anything in the property portfolio as it accrues in value is taxed at 40% on death, if you don't have a family investment company share structure and you don't have a discretionary trust with growth shares. So the reason we put the growth shares in is that as the company grows, so let's say we start with £1 million that goes into the company, and we grow that £1 million and we buy £3 million of property, and over time we refinance those assets as a property investor as the portfolio grows in value, and we take money out to expand the business and leverage. At this point in, say, 10, 20, 30, even 40 years from now, the value of the company becomes worth significantly more than on the day of incorporation. So let's just say, for ease of maths, that this was worth £3 million on the day of incorporation, using £1 million worth of money that they invested. And in 30 years' time, or 30, 40, 50 years' time upon death, and they want to pass the assets to the children, and the portfolio is now worth £10 million. There's £7 million worth of capital growth that would be liable to inheritance tax. But by pushing the growth of the portfolio into a discretionary trust, the £7 million of growth gets pushed. All that capital gets pushed into the discretionary trust, and therefore, when we pass or leave the assets to the children via the trust, or our grandchildren, or any of our heirs and loved ones and friends, if that's the case in this scenario, then we pass all of those assets free of taxes, because all of the estate and all of the growth sits outside of our estate. It sits in the trust. And remember that the trust is only ever valued at 10 pence. So when you pass those assets from the trust to any of your loved ones, the trust is only ever valued at 10 pence. And therefore, also, one of the key points here that we get asked a lot is, well, on a normal trust, basically what happens is, on the 10th anniversary of the trust, on the 10th anniversary, the 10-year anniversary, you get taxed 6%. You get taxed 6% of the value of the trust, and you have to pay that tax. However, in this situation, because the trust is only ever worth 10 pence, because there's only 10 shares in here valued at a penny, then the trust doesn't hold any significant value, and therefore there is really no tax due on the 10th anniversary of the trust, because it holds no value. Okay, now this is basically how this works. Now, the other reason why this is so great, not only does it save you all of the inheritance tax, and on an income tax basis, you can basically withdraw dividends using your marginal rate tax band at just 7.5%, so it becomes more income tax efficient. The other big thing about this company is that it allows for asset protection. Now, let's run a scenario, a classic example, that James and Sarah are married. They've got the 2 kids, as I explained. And as their 2 kids get older, the 2 kids get married as well. And therefore, James and Sarah have grandchildren in this scenario. And in this scenario that I'm going to run, let's say that one of the children, for the purpose of this conversation and example, one of the children gets married and they then get divorced. Now, in that situation, if we didn't have this structure in place and it was just a normal company structure and the shares were just left for James and Sarah's child in this situation that got divorced, then whatever the value of what is left for the child at that point that got divorced, 50% of that becomes part of the divorce settlement in the future of what's left to them. So what we do is by basically setting up the share structure in this way and freezing the shares so that James and Sarah's kids, the value of the shares are only ever worth 10 pence, then it doesn't become worth anything in the divorce settlement, because no solicitor acting on behalf of the divorcee is ever going to say, well, let's go after the properties or the value of the properties that James and Sarah's son or daughter in this situation holds, because they're only ever worth 10 pence. So again, it helps for asset protection as well. So key points then: voting rights are held by the parents, the owners of the company. No voting rights for any of the in-laws, for the grandchildren, or even the children in this situation. Purely given dividend rights so that we can use people's marginal rate of tax, which is 7.5% above the tax-free threshold. And then we push all of the capital growth into the discretionary trust, which helps us for inheritance tax planning. So what are the main benefits for you? Just to reiterate, so we can offset finance costs against rental income. There is no income tax to pay on the subjective company profits by creating a director's loan account. So when we set up a company, and in this scenario, if we're putting £1 million, just for the purpose of the conversation at this point, before we get into the client case study, the £1 million goes in as a director's loan account to the business. That creates an excellent tax planning opportunity for us as property investors, because the £1 million can be invested and leveraged on buy-to-let interest-only mortgages. Typically at 75% is what we do as property investors, but it can be lower. But if we're leveraging it to the max, we're going to leverage at 75% loan-to-value mortgages and 25% deposits. As we expand the business and the company starts to give us net cash flow and profits, we can basically draw down on those profits using our director's loan account. So we can draw all of the income from the property portfolio into our personal names alongside any other earnings, completely free of taxes, up until the director's loan account has been used. So that's another great reason why we recommend you set up a limited company in this situation. Now, over buying in your personal name, because anything you buy in your personal name is taxed at your higher rate tax band or your marginal rate tax band. And if you're a higher rate tax band, obviously section 24, you cannot offset your rental income against you cannot offset your rental income against finance costs, and therefore you end up paying a lot more taxes than you should. Now, the other benefit is that we can pay the private school fees and education fees tax efficiently through the creation of the alphabet share structure. The future company profits are taxed at just 19%, meaning your company grows faster. So we don't have any capital gains tax to worry about as well, because as a higher rate taxpayer, if we had properties in our own name, we're going to be, when we dispose of those assets and we liquidate the assets up on sale, we're going to be taxed at 28%. Whereas in a company, if you do dispose of any assets, you're only going to be taxed at 19% on the gain, because you're taxed on corporation tax, not capital gains tax, which means that also as well, your future capital growth is exempt from inheritance tax, as I said previously, which saves you hundreds of thousands of pounds, and your legacy is protected through your bloodline by the discretionary trust, again against divorce settlements and things like that may occur in the future, and you have the limitation of a liability to protect your personal wealth from business risks too, because it's in the limited company. Now, with everything in life, there's also some disadvantages and drawbacks. So what are the drawbacks of a family investment company? Well, they can be more costly to set up due to the legal fees incurred. So typically when you set up a family investment company, you'll need solicitors involved, you'll need barristers involved. And the reason for that is because you basically need to set up your power of attorneys, your wills, your letter of wishes, your mirror wills, and all these things if you're a married couple. And those things are the things that start to occur and are quite costly to set up in the beginning. But you're going to see in a second with the client case study that these costs are really the return on your investment by setting up a family investment company, which I'm going to show you in a second, is crazy, because you're just going to save hundreds, if not millions of pounds in the future. So that kind of becomes obsolete, but it's still a point of consideration. Now, not all professionals as well will understand the complexities of a specialist tax structure, which does limit you to using an allocated team of dedicated experts. Okay, so a lot of the accountants that you'll speak to may not be aware of a family investment share structure. They may not understand the legalities of family investment structure, and they may not understand the mechanics of it as well. So it's really important, if you're going to implement this, that you use a team that knows what they're doing, is a team of experts, and that does it every day and can advise you in the best way possible on your personal individual circumstances. And you can get the right legal protection and tax advice at the same time. Now, another drawback is that one of the biggest things that people ask us is, well, does this prohibit me getting mortgages if I have a family investment company? Now, typically no, because this structure is based on lenders not having anything that precludes the use of a family company setup. So most of the lenders, as far as we're aware, do not have any terms and conditions that stipulate the prevention of such structure. So basically, you shouldn't worry about it. If you're thinking about setting up a family investment company and you're worried about mortgages and all these sorts of things, again, if you use a team of experts and specialists, it should be fine. Now, again, this is why you need to get all of the right advice from a barrister and a good tax team, so that when you get mortgages, you can kind of check that stuff off and you've got a broker who's familiar with your setup. And the reason being is because the terms and conditions in the mortgages or in the application, they never really ask you or talk about the stopping or preventing the use of a family investment company. They don't have it in their terms and conditions. They don't talk about trusts usually, and therefore it's something that doesn't need to kind of be put down on the application form unless the application form asks for it. Now, again, I must repeat myself here, disclaimer, whenever you go for a mortgage, you need to talk to your broker and you need to get the right mortgage that is right for you in your personal situation. If you're setting up a family investment company, then again, this goes back to this point here where you need to basically have a team of dedicated experts that understand what they're doing. But as far as we're aware, to the best of our knowledge, as our tax team will tell you, that mortgages are fine. However, following the point above, there are only two mortgages that we're aware of, or that I'm aware of anyway, that prohibit the use of a family investment company. And that's fleet mortgages and capital home loans. They prevent the use of such structure, and therefore we cannot approach these two lenders if we have a family investment company in place. Now, this brings on to the last point, which means that you will need to check that the terms and conditions of each mortgage that you apply for does not prohibit the use. And you need to get people to advise and check accordingly if you want a belts and braces approach. Again, just goes back and reiterates the point that I was saying up here, that if you do implement a family investment company structure, you need to make sure you've got the right team in place, the right mortgage broker, the right property accountant, the right tax team, and the right barristers and solicitors and legal team to work alongside you as well to set that up. Now, I just really want to talk to you about a client case study and what's really worked for our clients, and really put this almost fictitious example into real life application. So in this client case study, we set up this structure here for them. So for James and Sarah, we set this exact structure up for them using our tax specialist team. And basically, the biggest benefit of a smart company structure or a family investment company structure, in my opinion, is the amount of inheritance tax that you save above anything else. That's the key here. Now, the reason why this is so important is because this work here that's been done by tax specialists and this report that was done from our tax specialists demonstrates that UK house prices have increased by 128 times over the last 70 years. So on this graph here, in Q1 1954, house prices were £1,891, but in Q3 in 2020, the average house price in the UK was reported to be £242,709, which means that the UK average house price since 1952 has gone up over 128 times over the last 70 years, which is significant. And another thing is that, just to cover this off, like, when does it stop is a great question. And nobody really knows the answer to that question. However, when we take educated decisions and we look at data as property investors, I always look at the past to dictate my future decision-making process, because I have a saying that I've learned that basically history has a process of repeating itself. So we don't see, or any reason I don't see specifically, why house prices are going to not follow this trend in the future. Yes, we'll see booms, we'll see recessions, we'll see things go up, we'll see things go down, but the general curve is always going to be along that exponential growth curve. So effectively, if house prices are always going to be going up, then we need to solve the capital gains tax problem, and we need to solve the inheritance tax problem, which a smart company structure does very, very well indeed, as explained prior. Now, let's put this into some numbers and really bring this to life. So in this example, this specific client, which we're using James and Sarah as the example here, James and Sarah had £790,000 worth of property, right? And the mortgages outstanding on their £790,000 of property was £630,630. So it's at 58% loan to value. They were leveraged to 58%. Now, if in this situation, James and Sarah don't buy any more properties, looking at the graph above and assuming different variables, we can say that if house prices just double over James and Sarah's lifetime, that the portfolio value is going to go from 790,000 to 1,580,000. And if the mortgages outstanding remain the same at £461,630, then effectively, in this example here, £328,370 is exposed to inheritance tax, which means that 40% of the £328,000 is £131,000 of inheritance tax that James and Sarah's heirs and loved ones would have to pay upon their death, which is a significant amount. Now, as we start to look at what if scenarios of if they quadruple, then things start to play out a little differently, and the savings go up even more. So, and the cost of the the cost of the inheritance tax goes up. So if the portfolio value quadrupled over James and Sarah's lifetime, then it would be worth £3,160,000. Again, if they did nothing, James and Sarah have £1.9 million exposed to inheritance tax, giving them a tax bill of £763,348 if they did nothing, and if they set this up in a normal limited company structure, or if they kept the properties in their own name, their estate is going to be taxed at 40% upon death. Now, if the portfolio value of the properties went up tenfold, which is, could happen looking at this graph and the fact that house prices have gone up 128 times over the last 70 years. If we're thinking about intergenerational wealth for our families and loved ones, then if our portfolio was to go up tenfold in this example, so if James and Sarah's portfolio went up to 7.9 million, you can see here that 6,648,000 is exposed to inheritance tax, which is giving James and Sarah a tax bill of 2.6 million if they didn't have a family investment company structure in place. So in this scenario, the savings are 2.6 million at tenfold, 763,000 if they just quadrupled in value, and if they just doubled in value, you're still saving £131,000 by setting up a family investment company structure. So hopefully you can start to see now why what I've learned from looking at my own estate and looking at my clients' estates, that family investment companies are really, really beneficial, and they're a great investment for inheritance tax purposes alone, notwithstanding the other benefits of the education fees, paying the private school fees, paying the university fees, using people's marginal rates of tax to withdraw income from the portfolio. These are all things why family investment company structures are very beneficial to us as property investors, and why our clients use them. Now, if we start to expand on this, remember that this is the current value of their portfolio, and this is the scenario that if they just did nothing and didn't buy any more properties, well, if James and Sarah started to buy more properties in this scenario, and let's say that they had £370,000 of cash to leverage. So they had a portfolio worth $790,000. That was what their existing portfolio is worth. They had £370,000 of cash that they needed, or that they had available to them to grow the portfolio. And if they spent that £370,000 at 75% loan to value leverage across the portfolio, they could add an additional £1,483,480 worth of property to the portfolio. Adding the £1,483,000 to the original $790,000 gives them a portfolio value of £2.5 million. Now, in this scenario at leverage, if they use that £370,000 to leverage their portfolio, the mortgages go up to £1,945,000 at 75%, with a £2.5 million portfolio value. So in this scenario, assuming growth and assuming scale, then if at this point James and Sarah were to do nothing after they added the new properties to their portfolio, if they just doubled in value, that would go up to 5 million. The property portfolio would go up to 5 million in this scenario. The mortgage would stay the same at 1.9 million, meaning the potential growth exposed to inheritance tax is £2,131,850. And if they didn't have this structure in place, that means that James and Sarah's tax bill would be $852,000. So with implementing a structure like this, they actually save $852,000 in this scenario. Now, it gets even worse at scale. If we think about over the lifetime of this intergenerational wealth, if this property portfolio were to quadruple over the years of ownership, the properties would go up to £10 million in value, and the potential growth exposed to inheritance tax would be 7 million in this scenario, which gives them an additional inheritance tax to pay of just under 3 million pounds if they had this in a normal company structure. And again, if they were to go up to tenfold, so the properties were to increase in value to 25 million over the lifetime of the portfolio, and the mortgages stayed the same at 1.9 million, then the exposure to inheritance tax, if they did nothing and had it in their own name or a normal limited company, would be £22 million, which is giving them a tax bill of £9 million in that scenario. So again, you can see the significant savings that you make by implementing a family investment company structure when you're looking to build a property portfolio. And if there's anything that I've learned and can share with you in this video, I've learned in my life and from doing that, and from learning from other people who are above me, and having lots of mentors myself, I've realized that it's not about how much money you make that's important. The only thing that truly matters is how much money you keep and then multiply, because this is the essence of how to build wealth. And that really concludes this video. So I hope you found it useful. Let me know in the comments, give me some feedback. Just write in the comments below what you thought of this video, if it was helpful to you. If you've got any questions, you can also type in the comment section below. Ask any questions you want, and myself or someone from my team will answer those questions for you. And yeah, we'd love to see your feedback, because we want to give as much value on this channel as we possibly can, so that you guys can take action and basically start implementing these things for yourself if you feel that this is valuable to you. If you don't, that's also okay. If it doesn't apply to you, that's also okay as well. But if you like this video, give it a thumbs up, hit the like button, click subscribe, and you'll be notified of new videos that come out when they're released. My goal is to release at least one new video every single week of content that hopefully inspires you, and things that I learn along the way, and we'll share with you what's working for me and also share with you what's working for our clients as well. And hopefully that's of use to you and service to you. So be resilient, be great. I believe in you. Go out there and set up your property portfolios in the right way, and I'll see you in the next video. Speak soon.